Who hasn't heard of Warren Buffett, one of the world's richest men, and a regular member on Forbes' list of billionaires? His estimated net worth in January 2022 was well over $100 billion. Buffett is regarded as outdated, an old economy investor who encourages everyone to invest in index funds.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time.
He is best known, however, as one of the world's most successful investors. That is why Warren Buffett's investment style is so popular among investors. He follows a set of core beliefs as well as an investment philosophy that is widely accepted around the world. So, what are his investing strategies? You might ask. You have to keep watching to find more about Buffett's strategy and how he's managed to amass such a fortune from his investments. Before we go any further, please hit the like and subscribe to help the channel hit 1,000 subs before the end of this year. And also comment down any other topic you want to be discussed in this channel. Buffett is a follower of the Benjamin Graham's value investing school. This type of investor, also known as a value investor, seeks out stocks with unjustifiably low prices in relation to their underlying intrinsic value. You're probably curious about this two words, intrinsic value. What exactly does this mean? Although there is no widely accepted method for calculating intrinsic value, it can be approximated by looking at a company's fundamentals. Like bargain hunters, value investors seeks out companies that are undervalued by the market or which are valuable, but are unknown to the majority of buyers. Now for the next important part of the video, let's look at Charlie Munger, who is in his own right a legendary investor. Explains.
We have to deal in things that we're capable of understanding. And then, once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life. That's a very simple set of ideas.
All of these rules might seem simple, but it is very hard to pull off. So for this video, let's take a look at the 4 investing rules that Buffett follows. Now, for rule number 1.
We have to deal in things that we're capable of understanding.
The first rule appears to be straightforward. Make sure that the business is one which you are familiar with and understand so that you know where your money is going. For example, something like Coca-Cola, let's say. And, if you don't know everything about the business at first, don't worry. If you work hard enough and put in the time learning about the business, you should be able to understand it. Not only should you be familiar with the company, but you should also be familiar with the industry. You don't want to choose a company at random in a field you're unfamiliar with. The most important thing I learned from this is to conduct your research before investing in a company and make sure it is something you are interested in. I discovered that using Circle of Competence to determine the type of company and industry that fits my understanding is an excellent way to start when picking individual stocks. Rule number 2.
And then, once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage.
Your initial impression when seeing this rule will be confusing. Aren't moats a form of protective water barrier for a castle? It turns out that a moat for your money is exactly that. A moat is a form of competitive advantage that a corporation has that sets it apart and renders it untouchable by competitors for a long time, and allowing the business to produce strong cash flows, similar to how a moat protects a castle from attacks. The moat must be something that is inextricably linked to the business and is long-lasting, such as a brand. Let's follow up with our Coke example. It has everlasting brand image and big portfolio of billion-dollar brands that it can market and turn a profit. Rule number 3.
And then, of course, we would vastly prefer a management in place with a lot of integrity and talent.
When choosing a company to invest in, I realized that I need a company with the best management team I can find. In their shareholder letters, you can learn a lot about the CEO's background, how skilled they are, and how much of their net worth is in the company's stock. You also can look into how satisfied are the company's employees. Employee satisfaction can reveal a lot about how well a company's management is doing. Check to see if the company has any debt and what its intentions are for paying it off. Do they intend to take on more debt in the future? All this question can fulfill the third rule. Finally, rule number 4.
No matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life.
Charlie Munger advises against paying a high price for a company in this last rule. Wait until the price is fair, and then wait some more. It's time to buy when the price is more than affordable. Purchase the company at a reasonable price, preferably on sale, with a margin of safety built on it. The margin of safety is a price below the company's value that will protect me from the majority of mistakes if my pricing analysis is incorrect. This fourth premise was the most difficult for me because it includes math, something I have never been good at. The 3 calculations to figure out the valuation of a company are: 1. Cap rate valuation, which is based on the earnings. 2. Discounted cash flow, which is based on the free cash flow. 3. Cigar butt valuation, which is based on book value. I'm not going to cover valuation method in this video, because it might be too long. You might be asking, why can't there be simply one simple calculation? However, I discovered that having 3 various approaches to arrive at a pricing drives you to learn more about the business, and the more you learn about the business, the easier it is to determine the best price to pay. For fun, I experimented with this. Using all this valuation method, I just keep analyzing stocks, and I end up not buying any, as prices are just too high. But well, that's how things are in today's market. Everything is expensive. Now wonder Warren Buffett is holding so much cash in this portfolio, waiting for that one big buy. With this, hopefully you guys are able to understand this 4 simple yet complex investing rule that have made Warren and also Charlie Munger very wealthy. If you're not subscribed to the channel, then feel free to hit the like and subscribe button to help the channel out. With that, Business Wisdom, signing out.